Okay, Isaac, I see you're dialed into the Zoom room. Give me a thumbs up or something if you can hear me, or just let me know if you can hear me. Okay, I got a thumbs up and we're recording. So this will be archived, saved out to our YouTube channel, so good news. Okay, it took me 10 minutes to get set up. You had a question? Okay, well. There's other people who probably have the same question. Typically, it helps me out if you ask me.
I sent you an email about it. It was the question.
Oh, great, I got your email, yes, and thank you for asking that for the whole class, because that is relevant to everybody in the class. So that was all of the above question, right? Okay, and give me your name again. Tangus.
Tangus.
Tangus, thank you, appreciate it. So Tangus got a question on the exam that was a little wonky. I don't know, number 2 or something like that. It said it's an A, B, C, D, all of the above, pick which ones apply. And I think you chose all of the above, but it wanted like you to check all of the boxes or something like that. So yes, imagine the challenge if you were the 2 professors that wrote this book and had to come up with new material and new questions every 3rd semester, or you wouldn't get paid anymore. There's a lot of errors that crop up in these things. So I'll go in and I'll make the adjustment and make sure everybody gets credit. We good? Okay, awesome. So whatever you got on the exam, give yourself another 2 points. I was thrilled with the grades. You all, for the most part, scored very, very well. As a class, the scores were about as high as I've ever seen, so.
You say this was the hardest exam?
No.
The easiest.
They only get harder from here, as tonight's lecture will indicate. We get to talk about bond pricing. Woo. So if you did struggle on the first exam, it's not too late to rally. You just wanna double down and rededicate yourself to some of the videos online. I mean, there's resources as a block school if you contact your advisor to get you into a tutorial program. I have seen this in the past where some of the basic accounting has lagged a little bit, and a tutor can help if you're just weren't happy with that score. Notwithstanding, remember how I've set this class up. Those exams are, while the scores were good, they are meant to test you. I mean, really test you. It's the exam scores that will make the difference between the A's and the B's and the C's in this class. Because we have so many points that are the research project, the homework, these little flashcards, and you can do those as many times as you want. Those are all available points. There's no reason why, if you want them, they shouldn't just be yours to go grab. You know, you do a homework assignment once, you don't get the grade you want it, just do it again. So I consider that there's 1,000 points in the semester. 700 of them are homework and research projects. No, what are the exams? 150 a piece, 100 a piece?
150.
150. So they're more than half of the class are. They're not freebie points, but they're available. Just do the work, you're gonna get those. So if you didn't get the score on the first exam that you're hoping for, just take a deep breath, acknowledge that. We'll move forward through the semester, and I bet lots of people do just. So I was out last week and I was sick the week before. Thank you for accommodating me, I appreciate it. What questions did you have about the exam, the homework? Next week is our halfway mark through the semester. So at this point, you should, well, if you read the syllabus, I tell you to keep pace every week with the research project, but I know that's not how things work. So you should be turning your attentions to that research project a little bit, starting to gather some of that data. What questions do you have for me? Yes,
So for the research project, there's like specific formatting that you want us to use. Are you gonna show us how to do that, or should we just go to the writing studio?
well, I'm not gonna show you how to do it. But it should be very simple.
Okay,
So there's a template on the Canvas site.
okay,
So if you download that template, all you have to do is put numbers and words into it. So it's that, yes, I require a format and I've already done it for you.
okay,
You don't have to create anything. Use the templates that are stored on Canvas and you're gonna be good.
Okay.
Now, I'm anal about that because at the end of the semester, I have 30 research projects. And that's, okay. This is a healthy exercise for you all to engage in. Imagine that we've just switched places and it's the end of the semester and you've been handed a stack of 30 research papers and well, that's at least a weekend of your time. So you've probably come up with shortcuts and mnemonic devices and other helpful strategies to allow you to grade 30 research papers that can be 50 to 60 pages in length over the course of a weekend. Standard formatting is one of those. So I look for things very quickly, and these research papers are designed that way for a reason. That cover page is, I place a lot of weight in that cover page. And it's designed the way it is for a reason. You have company descriptions, you have key financial metrics right on the front page, you have valuation metrics right on the front page. On the front page, you compare 10 or 12 different metrics to both the 3, 5, and 10-year historical averages of the companies that you're working on and to the peer group. So we have valuation right there. Then on the right-hand side, we have management, moat, mispricing, and mark, that 4M's framework. And I'm looking for very concise, original writing on that front page. And then finally, there's a paragraph for summary. I would look for that to be a very hard-hitting, concise summary of a 60-page paper. So that needs to be well done. Put a lot of effort into that front page. Then the next 8, 10, 12 pages are your executive summary. And that's really the report right there. 8 to 12 pages of an executive summary and a cover page that support another 50 pages of research. But that 50 pages of research, it's messy. There's a lot of copy and paste. I want your bibliography and works cited page to be well done. And if you do that and you make that well done, what it allows you to do is cut and paste 50 pages worth of material. I found this over here, I found this over here, I found this over here. None of that's plagiarism. I'm not holding you accountable for any original work. Just go out and grab the compelling material that answer all of the relevant accounting questions about why you believe what it is that you believe about the company that you're doing business on, work on, and then just cite it. And I think as you begin to go through the projects, especially if you do it firstly by watching the video on how to create the works cited page, watch that video. Begin with the end in mind. I think you'll find it all comes together a lot more quickly and easily than you expect. I'm dressed a little casually today. Thank you for your understanding. We had a team builder today. I was at Wayside Waves. Believe it or not, reading to dogs. So I didn't know that was a thing, but yes, they will have you come and keep their dogs company. I made it out of there without adopting a new dog, so I'm calling that a success. Anybody ever been out there, adopted a dog? We have dog lovers in this class. How many? A few, maybe half the class. All right. We adopted the dog we have now. We didn't adopt from Wayside Waste, but it is a rescue dog. There used to be, and this is so unfortunate that it doesn't exist anymore. There used to be a rescue facility out at the Lansing State Penitentiary in Lansing, Kansas, which is over west of Kansas City, Kansas. So the inmates would train, rehabilitate, wash, groom, they'd work with the dogs. And you could go up there and pick up these strays and they'd be trained. And I can't imagine a better work detail if you found yourself, pinched in life and now you gotta serve some time in the penitentiary while working with dogs. So I got the best picture of me and my 4 daughters, who were probably between the ages of 6 and 12 at the time. We had to check in through their security system at the penitentiary to go pick up our dogs, so we're at the jail adopting our hound lab mix. His name's Lincoln. Well, it's probably been 6 or 8 years ago now. One of the inmates figured out that they could pose as a dog and escaped from prison in the dog crates as they were coming and going, because they have a monitoring facility which detects heartbeats. So they made it out of the prison and it shut down the whole system. So that's a shame. We gotta go to Wayside Way. All right, tonight we're gonna talk about liability recognition and non-owner financing. I got a chat, I'm gonna chat here. Isaac says, my car is still in the shop, no headlights. Okay, I think that's learning objective number 4 in liability recognition and non-owner financing. So just hold the line there, Isaac, and we'll get that. I'm joking. I have no help for you. All right. Okay, so with tonight's lecture at a high level, we're gonna walk through the right hand and the left hand side of the balance sheet, I guess, or right hand side of the balance sheet, or bottom half of the balance sheet. We're talking about liabilities. So we already spent some time talking about assets and we worked our way through the revenue statement. Now we're gonna talk about how the liabilities get on the balance sheet, either through specific transactions or accruals. So we're gonna start with accruals. I'm gonna point out some tables that you all should be familiar with that you can find in the 10K. Point out some fine print that you should be familiarizing yourselves with, and then we're gonna take a tour of the bond market. One of the most basic concepts in finance is that when bond prices rise, yields fall. And when yields rise, bond prices fall. That inverse relationship is very, very confusing to most first-time investors. It's very confusing to my clients who we work with. It's very confusing to a lot of very smart other professionals, including engineers, doctors, and attorneys. I've been working with these people for 20 years, and it's not an intuitive concept. So we're going to belabor that discussion just a little bit tonight so that we can all understand the principles that are the underlying and driving dynamics of that discussion. Probably review for a lot of you. I'm hopeful that I can put a little bit of color on it in a way that might help, because even I find myself having to break down some of these dynamics on a weekly basis or quarterly basis when the Fed funds rate moves, or we see certain fixed income investments available to our clients that seem oddly priced for one reason or another, and that might be due to credit risk or interest rates or so on and so forth. So we're going to talk about them. Before we get to the bond market, let's look at the balance sheet. We start with accrued liabilities. In this illustration, I think module 7, we're dealing with Verizon, but I don't remember for sure. You're going to see current liabilities on, it is Verizon. On Verizon's balance sheet here, you see current liabilities of $37 billion, broken down between debt maturing within 1 year, accounts payable and accrued liabilities, and other liabilities. So familiarize yourself with that section. And then tonight, we're specifically going to talk about accrued liabilities. Everything else that you just saw there on the balance sheet is the direct result of a transaction. So we borrow money in exchange for, or in exchange for a good or a service, and we probably get a receipt to show for that. And then we journalize that receipt in our books and records. Accrued liabilities only get posted to the journals and then subsequently financial statements based on the passage of time. So no, there's no transaction associated with these. Everything else that gets on the statements, there's transactional. In this instance, there's no transactional, and yet something has occurred. And what is that something? Well, through the passage of time, we now owe a third party. So, in my estimation, the simplest way to think about this is through wages. So I get paid twice a month. Our firm cuts checks to myself and everybody else on the 15th and the 30th. That's a bad example, because we wouldn't have any accrued liabilities if we cut the check at the end of the month. Let's say you get paid every 2 weeks. And the quarter ends or the year ends and you're halfway through a pay cycle. Well, there's a week that has accrued, a week that represents time that has elapsed. Employees have worked for you during that time. You now owe them money, but you haven't paid them any money. That money's due to them. You owe them a check. So we're gonna make an entry on our financial statements that shows that. And it's a very simple journal entry that says wages expense, call it $10,000, wages payable, $10,000, and that's called an accrual. And those little accruals happen at the end of an accounting cycle for all kinds of reasons. Somebody give me another example.
Your interest payment on the car is not like at the first of the month.
Yep, interest is a great example, wages payable,
Utilities.
utilities.
Taxes.
Utilities is a good one. He really made me think with utilities. Because the answer to that question is yes. But typically, we don't have enough visibility into what the payable is going to be. Like we don't, like with utilities, the utility tracks your usage. So we don't track usage. I don't know how many kilowatt hours I've produced halfway through the month or I've used halfway through the month. So I've never had that come up in class before. You don't typically see utilities booked as an accrual, but you could. You do owe it. It would technically be more accurate. But as the accounting goes, I would venture to say most companies consider that to be de minimis or non-material, so it doesn't get booked. But that's an interesting conversation. Somebody else had one over here.
I said taxes,
Taxes is,
like at the end of the year, you
Yep.
have taxes.
yes, absolutely. Taxes is one that usually shows up in quarterly accruals, and you'll send those payments in advance to the IRS. So based on last year's number, you'll pay an estimated tax amount, and that journal entry would happen quarterly. Rent is another one, insurance is another one, so on and so forth. These crop up all over the place. Okay, so there's two broad categories. We're talking about routine contractual liabilities with this discussion here. What we've left out are contingent liabilities. So these are things that we know we're gonna have to pay, but they're not routine. So the two examples that our authors give us are litigation and warranty liabilities. Warranty liabilities is a little bit more predictable. And our authors gave us the example of Harley Davidson. Harley's been around for, I don't know how long, 100 years. But when you've been making motorcycles for 100 years, you have a pretty good feel for how many of those are gonna require some fix-it work that would show up as a warranty expense on your income statement. We talked about bad debt expense and uncollectible accounts a couple weeks ago. This is very similar because we have so much data to work with, that warranty expense becomes predictable. which are two of the components that we have to book contingent liabilities. It has to be probable. Probable means more likely than not. So greater than 50% chance that a liability is actually going to occur. And then it has to be something that we can estimate. So with litigation expense, both of those things are very challenging. So the way it was explained to me, and I think this is still pretty accurate because there's a lot of leeway when it comes to litigation expense, is that your company wouldn't be litigating if they didn't think there was a better than 50-50 chance they were going to win. Okay, so right there, one of the criteria was probable. So if you take the viewpoint that your company wouldn't litigate unless they thought there was a better than 50-50 chance they'd win, litigation would never get booked. Here's another example. Attorneys are smart, very smart, and accounting methodologies are known to them. So if you're an attorney and you know that the accounting rules require something to be probable, and a company has booked that contingent liability, so it's on their balance sheet. Well, then in cross-examination as the attorney, you're gonna say, oh, well, Mr. or Mrs. So-and-so, tell me about the rules that FASB imposes on contingent liability. And you're gonna ask, what does probable mean? And then you're gonna call their attention to the fact that they put that on their balance sheet. And then you're gonna call the jury's attention to the fact that even the accused believes there's a more than 50% chance that they're guilty in this matter, else they wouldn't have put it on their balance sheet according to the accounting rules. So in some manner of speaking, you could point to that and say, well, even they think they're guilty. So in practice, you rarely see these things. What's that mean for us? Well, as analysts, it means that, well, we know that now. The genie's out of the bottle. So if your company has any pending legal legislation, you're gonna really need to dig in, because they have not done the work for you. Or if they have done the work for you, it has not been disclosed. So I would suggest consulting Bloomberg, consulting some Wall Street research, maybe getting your hands on some of the Standard & Poor's, Moody's, Fitch research reports that we're gonna look at tonight. And hopefully, through that kind of network of experts, you will be able to gather some opinions that, you know, won't require you all to go to law school after you're done with this class. Here's the wages payable example that I was mentioning a moment ago. This is how it would actually get booked. So in this example, we have, if the liability for unpaid wages is not reflected on the balance sheet, liabilities are going to be understated, profit will be overstated, just won't be accurate. So how do we make that adjustment? Well, in period one, we have accrued $75 for employee wages earned at period end. We're gonna credit a wages payable for $75. We're gonna debit a wages expense for $75, and that's gonna flow through to net income and ultimately retained earnings. And it will decrease that by $75. Then in period two, when we actually write the check for those wages, we're gonna credit cash for $75 and we're gonna debit wages payable for $75, which is a canceling entry basically, because we both credited and debited wages payable at that point. Nothing too complex about this entry. Get familiar with it, because that's the same entry for any other accrual that will apply to this accrual liabilities that would this. Okay, if you all can benefit from my past mistakes, then let me clue you in on something that took me way too long to recognize. I struggled with this forever. I don't know why I had such a mental block with it. Here you go. Deferred revenue and unearned revenue are the exact same thing. Took me forever to realize that. I'd see deferred revenue and then in another accounting course or in another book or in another problem, I'd see authors refer to it as unearned revenue and my brain would just quit on it. I don't know why we can't just get some uniformity on one term. Maybe that'd be too easy. Think of it as one term, but they're interchangeable, deferred revenue and unearned revenue. So we just talked about wages payable as a liability. Somebody break down the concept of deferred revenue or unearned revenue. How do we book a revenue that's not earned?
Like prepayments, like Chiefs tickets, you buy your whole season and then you technically they don't earn the revenue until you show up for the game.
Great example. Perfect. So deferred revenue / unearned revenue, we have typically received the cash. And remember how basic accounting and transactional accounting works. There's gotta be a give, and there's gotta be a take. There has to be a transaction. Well, in this example is Elizabeth, right? This example that Elizabeth gave, we have part of that transaction has taken place. We've received the cash. But the second part of that transaction has not taken place, which means we have to do something.
What would the sign-on bonus be?
Hmm,
Cause you've done your job by signing on.
that's a complicated question. If that's it, if there are no strings attached to it, then the transaction is complete and it would not be unearned revenue or deferred revenue. But if the sign-on bonus required you to stay for 30 days, and then it would be earned over pro rata basis over that period of time. And there can be other strings attached to that would represent some sort of vesting. But in this unearned revenue scenario, we have to complete that transaction, and that transaction can take years. The Chiefs ticket's gonna take a Chiefs season. If we have music royalties or we've licensed some piece of software, typically there's time associated with that. We license a piece of software for 6 months or a year, or my Strava subscription is a year subscription. That's about the only social media platform that I subscribe to, just because it annoys my wife. So here's another aspect of that deferred revenue or unearned revenue that I've struggled with, and I know a lot of students have struggled with, which is the revenue part. This whole module is on liabilities. Revenue sounds like a good thing, and it is a good thing. But the unearned aspect of it takes what we typically think of as a revenue or maybe even an asset because we've received cash and completely recategorizes. Now we gotta take this account and throw it down into the liability section of the balance sheet. And why is that? Because when we have not yet earned it, when it's unearned, that's a liability of the company. We have to perform some good or service. So we don't owe cash, but we owe something. We owe that good or service. And now the unearned revenue or the deferred revenue becomes a liability, and we'll book that on the balance sheet accordingly. Okay, touched on everything on that slide. Talked about probable, talked about estimable with regard to lawsuits. Here's an example of how you're gonna see that. Everybody in the room, I want you to find this. Look in your 10K filing, look for any contingent liabilities, accrued liabilities will just show up on the balance sheet, but contingent liabilities will be a little bit more prominent, and you'll have disclosure language, especially when you get into warranties. And warranties can be a huge deal. If you're Harley Davidson or some other manufacturer that's been around for decades, you probably know that 3.25% of all goods and services sold come back defective. But if you're a pharmaceutical and you belong, so I'm thinking of, anybody remember Fen-Phen? So Fen-Phen was this diet drug, and it worked wonders. Seemed like half of the country was on Fen-Phen back in the early 90s, late 80s, and I forget who made it. But it worked until it didn't work, and then it started causing heart attacks. And that was really bad news. So the manufacturer nearly went broke. I'm gonna have to refresh my memory on Fen-Phen and who the major players were and what the liability was. The point I'm trying to make is that with a drug like that, if you have nasty side effects, there are not only gonna be contingent lawsuits out there that could show up as liabilities, but there's also gonna be huge product warranty issues. So it's your job as analysts to be able to come to some conclusion about how good of a job the company's management team is doing at booking those future warranty expenses. Let's dive into that a little bit. Because what color is this word right here? It's bright red. It's bright red for a reason, because it says estimated cost. And whenever you see the word estimated, the next question is, well, who estimates? The answer to that question is almost always the management team. That gives you some insights into another little area of accounting that can be manipulated to serve somebody else's purposes other than the investors of the company. Because management is not always perfectly aligned with the investors, which is why we start the semester out by looking at the proxy, because we want to know what motivates the management team. So this is a great place for company management to play that little game of find a penny. If you want to underestimate warranty liability to report higher current income. If you underestimate warranty liability, every penny you underestimate by immediately drops to net income. And that's entirely within your discretion, 100% within your discretion. So all you have to say, we'll continue on with the example of Harley Davidson. All you have to say is that we reinvested in our software systems, plant efficiency, Six Sigma techniques, and we expect a higher quality product this year than last year. That's all just yapping, right? You're just telling a story. So what you do with that story is you use it as justification to lower your warranty liability and increase your profit. Now, when that story, this is where the cynic comes. When that story just so happens to coincide with triggering management's bonus or driving the stock up so that their options can vest during that particular period, when you hear that story and you see the options vest and you see the management team get paid more than they might have otherwise, that's when little pink flags start going on. And that's what I'm trying to get everybody in this class to recognize, that those estimates, they can lead to shenanigans. Okay, here's another game. In this thought exercise, I want you all to imagine that you were just appointed CEO. Okay, great. You got the CEO job. The CEO job, the newly minted CEO job, almost always comes with stock options. But here, just get a big pile of stock options. More than often, those stock options come with an exercise price. And that exercise price is, it's not uncommon for it to be set over the first 90 days that you take the job. Okay. What do you want to do in the first 90 days? Now, in this example, we're being completely nefarious. How can you get yourself paid by manipulating the accounting in the first 90 days? Well, what you could do Not advocating this, but I have seen it done. I've seen this done. Just, and it's maddening. Okay, so here's what you do. Here's the playbook. You get your CEO, your options are all gonna price in the first 90 days. What you wanna do is drive the stock down. You wanna drive the stock down as cheap as you can get it, so that your options price as low as possible. Now, you don't wanna drive the stock down by doing anything to the company that's gonna damage the company. You just wanna talk it down. You wanna give press releases that say, well, I'm thrilled about my new job. We have a great company here. Unfortunately, there are some strategy shifts that we're gonna be making that are gonna cause some restructuring. I envision a few quarters that are probably gonna be negative growth. But coming out of that, I think we're gonna be able to position the company for long-term acceleration. Yeah. Okay, so that's talking to company. Then you go in and you say, well, there was a couple of batches that came off of the line last year that they weren't higher quality, they were lower quality. So I think that warranty expense really needs to be a lot higher. So now you're actually changing the earnings of the company. Rather than making the earnings higher by underestimating your warranty liability, you're making the earnings lower by overestimating. Now, Wall Street doesn't like that. Earnings are going down, so stock price goes down. But remember, you're just playing with the accounting and telling stories. So what happens 6 months from now? What happens 12 months from now? Well, that product is as good as it ever was. You know you're not gonna get warranty expense higher than it has been historically. So 12 months from now, you're gonna basically be able to announce the reverse of that. And you're gonna say, things were a lot better than I thought they were. No, actually, what you're gonna say is, I was able to pull a rabbit out of a hat. This is where you pull. Did anybody see Saturday Night Live last week where they did that Trump skit? This is hysterical. He was talking about how overconfident he is with all of his boisterous, the way he sees it. So that's what you do as the CEO. You say, this was all my doing. This was all my doing. You let Wall Street know, and you see the stock skyrocketed. And now you've just pulled this maneuver where you jawboned the stock down, you priced your options, and then you told the story, you manipulated the accounting, then the stock goes up, and you did nothing but probably cashed in a very nice options package because you knew how the accounting. Okay. Do whatever you want with that. Liabilities, okay, I've touched on all that. Here's your job as the analyst. When and if you ever see companies manipulating the warranty expense or anything for that matter, if your attention identifies something that looks off to you, now it becomes your job as the analyst to correct the numbers. Okay, if the warranty expense is bad, what should it be? How do you identify warranty expense or warranty liability that's off? You know it's an estimate. How do you sniff out that it's a bad estimate? Very similar to how we sniffed out bad debt expense a few weeks ago. We're gonna look at it relative to history. So if we know that warranty expense has been 2% of sales for the last 10 years, and all of a sudden this year it's 3% of sales, what's going on? So if we want to correct for that, what we're going to do is we're going to take warranty expense as a percentage of revenues and average that over a period of time that we think is relevant. So in 2019, we have an outlier. We might ask ourselves, well, what would that have been if the warranty expense to revenues ratio was the same as it was for the last 3 years? Well, we'll compute an average of the last 3 years, which is 1.835%. We'll apply that to revenues for 2019, and we'll recalculate the warranty expense. After we recalculate the warranty expense for 2019 or the next year, wherever we are in the accounting cycle, we'll put that into the pro forma income statement, allow all the other numbers to shake out. And now we have a net income number that's more representative of what we believe it to be as analysts. We can use that number to make decisions about whether or not we want to buy the stock, sell the stock, so on and so. Okay, short-term debt. Short-term debt is fairly self-explanatory. There's gonna be two tables in your 10K. This is one of them. This is the less important table. But they should be together. This shows the interest, annual payment, principal reduction, principal balance, so on and so forth for every debt issuance that your company has made. You got a short-term one of those and you got a long-term. I want you to find them both. And I want you to recognize the cash payments that are gonna be due as debt comes due over the course of the next 1, 2, 3, 4, and 5 years. Then I want you to ask yourselves, where's that cash gonna come from? You have, so much cash due over the course of the next 5 years. What's your company's plan for paying that debt off? Now, if you're Apple and you're generating $100 billion of cash flow per quarter, well, that's where it's gonna come from. You just got so much cash, it's gonna be easy to pay that debt off. It's not a problem. But if you're a more indebted real estate company, I can't think of one right now, but that might be a little bit more of a project that you have to work through because they're not gonna be able to generate cash to pay that off. So do they already have a cash hoard sitting there? Do they plan to sell certain properties? Are they gonna be reliant on a joint venture or a partner or a banking finance maneuver of some kind? If they're relying on a bank, that might be problematic, because if we go through another environment like we did in the great financial crisis, or even earlier last year, about 12 months ago, we had 3 banks go broke in the United States, and we haven't seen that in almost a decade. And periods of time like that can cause liquidity crises. And if you find yourself in a liquidity crisis when one of these numbers needs to be paid off or renewed, well, all of a sudden, you might find yourself in bankruptcy. And many companies in the past have had to navigate something exactly like that. Okay, let's spend a little time talking about these bond packages. Anybody in this room ever bought a bond? 1, 2, okay, great. Chances are, you may have bought a bond inside of another mutual fund. It's very common for these to be bundled in a mutual fund wrapper, makes them a lot easier to buy. But if you look inside that wrapper, what you're gonna see are instruments that trade very similarly to stocks. So Microsoft, Google. Here's an interesting factoid that's off topic, but I looked it up for my clients this week. Last year, 2023, there's 7 movers that drove the market last year, that Wall Street is now referring to as the Magnificent Seven. NVIDIA, Google, Meta, Tesla, 3 more. They were up 111% last year. 111%. The S&P 500 was up 24%. If you remove those 7 stocks, which now comprise 30% of the weight in the S&P 500, the market was flat to down. Pretty amazing. Pretty amazing. So the point I was trying to make is that all of these companies issue debt. They borrow from the public markets. We can all lend them money. And companies like Goldman Sachs facilitate this transaction. So they take all the money that we lend them and they chop it up into bonds. And really, these are loans in increments of $1,000. And they trade back and forth. So there's an initial funding transaction that puts all this debt into the public markets. And then they trade back and forth. And it's that back and forth trading that doesn't have anything to do with Goldman Sachs, and it doesn't have anything to do with General Motors or Harley Davidson. That creates this dynamic of when interest rates rise, bond prices fall. And when interest rates fall, bond prices rise. Because, and I want to try to think through this in real time with everybody in the room, General Motors issues a bond at 5%. There's a huge opportunity cost for everybody in the room when interest rates go to 6%. So if interest rates are at 5%, General Motors issues a bond that pays 5%. It's $1,000 bond. It's worth $1,000. What happens when interest rates go to 6%? Well, I'm not gonna pay General Motors $1,000 for a bond that's only gonna pay me 5%, because now interest rates are at 6%. All of a sudden, that bond that General Motors underwrote, it's not worth $1,000 anymore. It's worth $950. And if I pay $950 for that bond, it's gonna pay 5%. The difference between 1,000 and 950, that's gonna create something called an effective yield of 6%. Now those bonds all of a sudden become interchangeable with every other bond in the market issued by General Motors or General Mills or Facebook or Google or what have you. Okay. Touched on secondary market, touched on bond prices. A little bit of terminology here on slide 22. Our authors talk about coupon rate and they differentiate that from market yield or effective rate. Here's, two other terms that are identical to one another, just like unearned revenue and deferred revenue. Market yield and effective rate are identical. Coupon rate is the rate that's stated, i.e. printed on the face of the bond. We don't trade in real paper stock certificates anymore, or real paper bonds, but used to be a piece of paper that would actually trade hands when you bought or sold. That doesn't happen anymore, but if it did, the coupon rate would be printed on the paper. That's the amount the company agrees to pay upon issue. And then as soon as that bond is issued, interest rates start to change. And as interest rates start to change, the price of the bond starts to bounce up and down. And that's all about opportunity. Okay, let's walk through an example here, and just hit me with questions as we go. I want to make sure everybody has a grasp and an understanding of this concept tonight. If we can just get this concept, if everybody can say, okay, I'm a B- on that, and I'm pretty sure I can get to an A by the time the exam rolls around, then we're gonna call tonight a win. So let's go through this example. Assume a company issues the following bond with a face amount of 10 million. A 6% annual coupon rate, which is paid semi-annually, that's common amongst bonds. 3% semi-annually, matures in 10 years, so we have 20 semi-annual payments. We can break this down. This is nothing more than a time value of money calculation. Those semi-annual interest payments are gonna hit us 20 times over the course of 10 years. So that's a $3,000 payment. We have a $10 million bond, that's 3% every 6 months, a $3,000 payment. Total cash flows associated with that, $6 million. So over the course of that 10 years, we're gonna receive $6 million in interest payments. And then at the end of that 10-year period, we're gonna get our initial 10-year money back. So we have a stream of cash flows, 20 payments of 300,000, and then we have one big lump sum payment when the bond comes due. This is the number listed in that table 2 slides ago that I want you all to be aware of when you're analyzing your companies. When something comes due and the date it comes due on, I want you to be aware of that. So in this example, we got 10 million coming due, that's maturity. We got a check for 10 million that we're gonna cash. We have $16 million in cash flows. Okay, so if the market demands 3% semi-annually, the bond price is 10 million. And the bond is issued at par. Okay. So we can do the time value of money math. The time value of this annuity, this $300,000 payment. If you look at the present value factor of an annuity paid over 10 years and 20 time periods. That factor is 14.87. I imagine most everybody in this room is either using a financial calculator or an Excel spreadsheet, and the books give you the formulas for that. But there is also something called the present value of an annuity factor, which is 14.87. So at any rate, the present value of that stream of cash flows is 4.463200. The present value of the single lump sum payment of 10 million, discounted back 10 years, is 5.5 million. Add up the annuity present value with the lump sum present value, and you get a present value for the bond at 10 million. Okay, what if the investor demands 4%? So now we had to call it January 1st, that bond was issued at 3%. And then interest rates rise, interest rates go to 4%. So what's that bond worth now? Well, because the bond carries a lower coupon rate, investors are not going to be willing to pay 10 million for that bond. I can go out and earn 4% on my money in the market today. I'm not about to pay full value for a bond over here that only yields 3%. So let's look at how that math works. Well, now we're going to use a different present value factor. We're going to set the present value factor equal to the 4% market rate. And when we change that 4% market rate, either using our present value factor or our financial calculators or the Excel spreadsheet, we get a new present value of 4 million. Same story for the lump sum payment. That's only now worth 4.5. Add those two together and we see that the value of our bond is now 8.6 million. The value of that bond just declined by $1.4 million when interest rates went up. And that's just the nature of the cash flows. That's the simple math of it when you break down the present value of those at different interest rates. Same story. If interest rates go down, well, now we have favorable interest rates. You can see our present value factor increased both for the annuity and the lump sum payment. Present value of the annuity goes to 4.9, lump sum 6.7. Now that bond's worth 11.6. Okay. In most instances, we're not going to have a perfect match between the coupon rate and the effective rate when we issue the bond. So almost all bonds are issued with a mismatch. If the coupon rate is greater than the effective rate, we're going to have the bond is going to be sold at a premium. If the coupon rate is less than the effective rate, then the bond is going to be sold at a discount. And if you look at the balance sheets of most of the companies that we're analyzing this semester, you're going to see those bonds booked either with a premium or a discount. It'll be listed on the balance sheet, and then that premium or discount is amortized over time with time. Not much different than accruing for wages expense.
Can you go back for a second?
Yeah.
Okay.
Kind of scratching my head a little bit here because I don't remember if it's in the scope of this class to amortize discounts and premiums. It's fairly technical. You've likely covered it in other courses. So let me just dog ear that one. And if we need to come back to amortizing discounts and premiums, we can. But as I was preparing for today's class, I didn't notice it in the lecture material, so I don't want to get off of it. Here's an illustration of how you would plug all those same cash flows into an Excel spreadsheet. So just star that one, come back to it. Okay, let's look at long-term debt. Nothing too technical about this section of the material. I just want to familiarize you all with what you're likely to see in the back of the 10K filing. You will show net debt and you will also see maturities. So this is a big deal for analyzing when cash flows are gonna be required to pay off this debt. Another thing that is very meaningful to me, and we'll talk about this later in the semester, which is weighted average cost of capital. In your finance class, you probably did a discounted cash flow analysis. Okay, in that, when you did that discounted cash flow analysis, you had to calculate a weighted average cost of capital. That includes not only a cost of equity, but a cost of debt. And generally speaking, we'll use an average cost of debt. Well, this table shows that Verizon, well, they pay somewhere between 1.38% on the low end and 8.95% on the high end. What's their cost of debt? Somewhere between 1 and 9? Well, that's a range a mile wide. How can that be? How can they be paying interest costs somewhere between 1 and 9? This is where the fixed income market and the debt market can get very interesting. And it's interesting in an esoteric kind of, I'd rather pull my fingernails out kind of way. Because to unearth some of the opportunities in this space, you not only have to dig through what seems like endless 10K filings, but then you have to dig through prospectuses and offering memoranda for every issuance of debt to understand why the range of interest can vary from 1 to 9. Because every single one of those issuances has different features, collateral, covenants. Remember covenants? Talked about those a few weeks ago. Those are basically nothing more than rules that are attached legally to any of these debt instruments. So all of those rules, features, collaterals, so on and so forth, have allowed for Verizon to negotiate with each of the counterparties on the other side of these debt issuances for different interest rates. So you can bet that this 1.38% is collateralized by something very strong. Whoever agreed to loan Verizon money at 1.38% doesn't have very much anxiety about getting that money. It's securitized. There's collateral there. It's better than your house. It's better than my house. It's very strong. On the other hand, whoever agreed to loan Verizon money at 8.95% probably doesn't have anything but Verizon's, oh yeah, I'll get that to you. There's no collateral underlying that one. And it might even be walled off in another LLC that could be international in nature or only unique to a certain locality. Like I said, this is where the fixed income market and the bond market can get very interesting. Because when you have that wide of a dispersion, you can see mispricing. And if you know what you're doing and you know where to look, you can identify inefficiencies. And if you can identify inefficiencies, that means opportunity for the investor. Become familiar with that table. Oh, okay, this is the comment I made just a moment ago. They took all of the bond amortization and shoved it in the appendix. Okay, so because it's in the appendix, I don't expect that to be testable material. We can move on. There might be a homework question on it, but I don't. Because these bond prices move up and down so significantly, if the company, Verizon in this case, ever decided they just wanted to buy that bond back from the public, we have publicly traded debt. If I borrow $1 billion, I ought to be able to pay it back anytime I want. Well, I can also go out into the public marketplace and buy that back. Well, in the example we just looked at a moment ago, there were $10 million worth of bonds originally financed. And in the first example, the value of that dropped to 8.6 million. Well, if you're Verizon, you might say, well, 8.6 million, I'd like to buy that back. That example I just gave would actually result in a gain on the early extinguishment of debt. If it were at a premium and you paid more than the original issuance, that would be a loss on the early extinguishment of debt. And that's common, as that debt bounces around. The unrealized gains and losses on that debt do not post to the income statement. If we actually realize those gains and losses, meaning we extinguish that debt, then we'll show a real gain or a real loss. In the meantime, and we'll get to this in a few more modules, I think this is module 10, those unrealized gains and losses are gonna go in a category of income called comprehensive. Okay, a little bit on credit rating agencies. I'm sure all of you are somewhat familiar with credit rating agencies. There's a handful of them in the United States that have been deemed to be regulatory significant. This is not just a game that anybody can play. There's only 7 in the US that have the government's stamp of approval to actually do this, and they're deemed to be credit worthy, respectable enough institutions to rate the quality of issues. And they do that by looking at credit risk. How do you analyze the credit risk of another company? Any company that any of you are doing research on this semester, how do you analyze the credit risk of that company?
Under the rating, there.
Look at your ratings. Yes, that's a great answer. Imagine you work for one of the ratings agencies and you've been tasked with analyzing credit of one of these businesses.
I would look at their revenue and see what their revenue was to how much they have out in debt and.
You're doing the exact same thing that we've been doing all semester long. If you want to know the likelihood that you're going to get paid back, which is you're analyzing the credit worthiness of another institution. What are you looking at? Well, you're looking at their balance sheet. You know, how much, what assets do they have? You're comparing that to what liabilities that they have. And then you're comparing that to their cash flow generating abilities both now and in the future. And to analyze cash flow generating abilities, you're looking at the industry dynamics and the company's mode and their profit margins and the competition in the industry. You're doing everything that an equity analyst is doing. When we identify a price target for any company that we're working on this semester, we're ultimately going to put this into a discounted cash flow analysis. We're going to forecast the financial statements into the future, income statement for the next 10 years. And we're concerned with net income. Well, the credit ratings agencies, they're concerned with earnings before interest. So you have net income, you have earnings before, you have net income, you have taxes, you have earnings before taxes, you have interest, and then you have earnings before interest and taxes. So there are 4 lines up on the income statement. The difference between equity analysts and credit analysts is 4 lines in a spreadsheet. Everything else is identical. After we do all of that identical work and come to some assessment about the quality of credit that we're looking at, we can graph that quality over time. And we graph it by looking at the difference in interest rates. So in this chart on the screen here, you can see the 10-year treasury in red. You can see how the interest rate on that 10-year treasury has varied over time. Going back to June of 14, it was at about 2.5. And by March of 19, it was at about 2.5. So it wobbles between A and B. Then what we call this difference between treasuries and AAA, or the difference between AAA and BAA, that's called a spread. You'll hear fixed income analysts refer to that term spread all the time, and it really drives the nature of their work. This is the historical relationship between bonds of a certain credit quality and treasuries. And you can see that it looks like June of 16, it got about as wide as we've seen it during that 5-year period. And that's an indicator. If that spread is typically 2%, anytime it gets to 3% or 4%, that's an indicator that bonds are getting expensive or cheap. So analysts pay a lot of attention. This is the scorecard, if you will. S&P, it's basically an ABCD system, just like we use for grading in any class. Only they complicate it a little bit by having AAA, AA, single A, triple B, and then this green dotted line is an important line of demarcation because that's the difference between high quality above the line and well, they used to call it junk. Below the line used to be called junk. And then somewhere around the turn of the century, early 2000s, in a stroke of genius, they rebranded it high yield. And now I guess they can sell it a lot better. But investors are wise to that game. They know junk and high yield is the same thing. So you have investment grade quality above the line, high yield below the line. If you're the CEO, if you're the CFO, you don't want to move from above the line to below the line because your interest rates are going to skyrocket. Well, and why is that? Because this is not necessarily a huge difference if you go from triple B minus to double B plus, but it is a huge because the investor community has gotten together and they have given mutual funds the power to go out and buy investments on their behalf. And those mutual funds always have a mandate, and that mandate determines what they can buy and sell. And most of the time, that mandate will either give a mutual fund the right to buy or sell investment grade or high yield. And if they have the opportunity to buy high yield, it's only in a small fraction. So the market for high yield is much, much smaller than for an investment grade. So when you go from investment grade to high yield, the market you have to sell your bonds contracts significantly. And when there are not as many buyers, you have to pay a higher price to sell your goods into that market. And that higher price in the world of fixed income means higher interest rates. Okay, I think this was the last slide I wanted to cover tonight. These are some of the key ratios that companies like Standard & Poor's and Moody's and Fitch look at when they're assessing the credit quality of a business. And you can see that, you just take that first column there, EBITDA to average, I think that's asset turnover. For AAA, it's 12.3. You can see for AA, 14.7, and then the ratio just gets worse as you go down the column there. Same for if you look at the columns from left to right. EBITDA to interest expense, EBITDA margin, operating margin, so on and so forth. And you can see the averages associated with each major debt grading. So my ask of you all is to use these numbers to benchmark the companies that you're looking at. So if you're looking at McDonald's and they have a single A credit rating and all of their ratios are, within plus or minus of this kind of middle range, you can probably give yourself some level of assurance that their debt rating is where it's supposed to be. But if you're looking at Ford Motor Company and they're at BAA and you don't want them to drop to B single A and their ratios are, consistently at the low end of these averages, that ought to raise a little pink flag. I would want to see that in the risks section of your report. The ratings do a pretty good job of forecasting which companies are in trouble and which companies aren't. If you look at 5-year default rates by rating, you can see here that Moody's Investor Services shows 0% of AAA rated companies default in the next 5 years. And as your ratings get worse, your default rates go up. So you would expect to see that exact relationship for any analyst that was any good at rating companies. If you didn't see that relationship, that would be problematic. Okay, to the appendix, we're not gonna cover the appendix tonight, so thank you all, that's our class. We'll be back, in this classroom next week. Thanks, Crew.